Coming up today, the stock market approaches all-time highs. Is it a fragile bounce? The leading indicators index falls, along with the price of crude oil. The SEC charges Carl Icahn, and I get you all prepped for this week. It's going to be another big one, guys. Let's go. And welcome back, everybody, to the start of a fresh week on Wall Street. And just like I was saying last week, starting to feel like Groundhog Day, isn't it? S&P 500 just put in its 8th consecutive higher daily close, as we're in the full thick of this V-shaped recovery. Who would have thought that 2 Mondays ago, when the VIX spiked up to 65? Here we are now, having almost slapped on another 500 points, and now we're only 60 points away from making new all-time highs. And stick with me today, because I'll show you some stats on what can happen to the market after we see this pattern. 8 consecutive days in a row finishing higher. We've also got a bunch of other interesting stats I'm going to share with you guys today, along with getting you prepped for what's coming this week and what we'll be paying attention to. Just looking at market color, about as bullish as it gets. Red everywhere the bulls want to see it. Volatility, bond yields, oil, the dollar index, and inflation expectations. Every stock sector and measure of risk on bullish sentiment. Green across the board. Except Bitcoin. It's not really joining in on this everything rally. And stick with me because I'll come back to the charts a bit later on in this video and we'll perform some technical analysis on all the most important markets, and I'll give you my opinion on where we're currently sitting with everything. First, let's just talk a bit about this bounce back in the stock market now that we're closing in on all-time highs again. What's taken us here? What are the risks? And what are some other key data point? So initially, investors got spooked from the jobs report earlier this month, coming in hotter than expected. It's kind of been a change in markets over the past few months, going from worrying about inflation coming back, the Fed even having to possibly increase rates again, to a relatively quick change to worrying about a recession and the downside risks in the economy. And this happened in tandem with the Bank of Japan surprising markets, increasing rates off rock bottom, indicating they're going to get more hawkish as well, keep increasing rates, caused a very sharp and nasty partial unwind from the real hot end of the yen carry trade, those that are really leveraged. Dialed down their bets in pretty quick order. And according to JP Morgan, that brutal rout in the stock market was just a dress rehearsal for what's to come. They think it could be a preview of larger issues ahead, with their analysts suggesting deaccelerating economic growth could be the next market trigger. And it's true, we are getting some mixed readings in the economy, with one of the weakest out there being the housing market. Last week, we got some data in showing new home construction starts dropped to the lowest level since 2020. Market coming off record prices, a huge government-induced boom from 2020. However, inventory's building on the market. Home builders are slashing their prices. The days it takes to sell a house across all Western markets is slowing as well. And there is a bit of correlation between housing starts and the S&P 500. We can see that in this chart here. In the dark blue, US housing starts year-over-year change. In the orange, S&P 500 year-over-year change. And we're currently showing a divergence on this chart that would suggest lower stock prices since the US housing market is pointing downwards. Another interesting study came out today showing that people are diverting stock investments into legal gambling, with the results showing household investments are reduced by roughly $2 for every $1 wagered, with lower income households disproportionately affected. The study showed net investments in the stock market fell nearly 14% in the 2 to 3 years following legalization in that state. And unfortunately, it also coincided with a dip in credit scores and an increase in bankruptcy. But getting back to stock market seasonality, we have had a pretty similar path to last year in the S&P 500, pulling back at the end of Q1, rising in Q2, going into Q3, rolling over a bit in August. And if we keep tracking this path, that would suggest a bit more downside for at least another month or two. I've even seen this chart being shared around on social media. In the blue line, S&P 500 this year, going from January to August. In the orange line, 1987, with this chart headline pointing out the similarity between the 7.5% drawdown in August 1987, recovered to a 2.5% drawdown before we had that Black Monday, where the stock market fell 20%. However, just like I've been showing you guys on the charts, with the huge amount of volume coming back into risk-on sectors, a lot of risk-on spreads, getting bullish again, there's some more research that suggests quantitative hedge funds could pile in another $200 billion into stocks over the coming months. A lot of big institutional money is based on what's known as vol targeting. They determine their exposures by the level of the VIX index, and with that crushing really low, that makes their models increase allocation to equities, not to mention all the trend following institutional money out there as well, with stocks close to breaking out to all-time highs, and with bond yields moving lower as well. Even more institutional money is based on relative yields, so that would suggest higher stock prices as well. And just looking at the breadth of this sell-off, it was actually tiny compared to those in the past. Just looking in the black here, the percentage of S&P stocks that made new 52-week lows was really shallow in the dip we just had a few weeks ago, showing not a lot of stocks were breaking down to new yearly lows. Also, the market's getting back to good news is good news again. Looking at the S&P's average one-day reaction to growth macro data, jobs, retail sales, manufacturing services PMIs, it's really starting to like that good economic data. Similar times we've seen this, early 2020 and early 2009. Both really good times to get into the stock market. And after last week, S&P did 7 straight days finishing higher. Looking back in history when it does that, and it adds on more than 6% in that win streak, 78% of the time we're higher a year later. Average return 11.6%. We've just done an 8-day win streak, and even though the odds drop a little bit, still pretty high. 73% of the time we're higher a year later. Also looking back at history in election years, a lot of the lows in the seasonally weak period from August to October are typically made in the first half of August. So like I said, it was possible that 2 Mondays ago was the lowest point we'll trade again for the rest of the year. The very best case scenario could potentially be playing out here at 5,100. However, some are still calling it a fragile bounce. Jay Powell could certainly upset it. If he even came out as being slightly hawkish when we get to hear from him this Friday morning from Jackson Hole. The market's really looking for him to confirm that we're on the verge of rate cuts next month. So that's the big event this week we'll be paying attention to. And just looking back at history, at the S&P 500's performance, around Jackson Hole meeting, the prior 5 days, we average about a 0.2% gain. The 5 days after, a lot better, 0.7, and for that whole period, 0.9. So pretty bullish coming out of it. And I guess you could attribute that to some fear and uncertainty going into Jackson Hole. Then when the market knows what they're dealing with, it can kind of relax and tick up a bit. And that appears to be the case in the bond market, in a bit of a wait and hold mode. Treasury yields just trading sideways, just as they did last week. Looking at the 2-year here, still holding above 4%, and the 10-year still sitting in this support zone, 387. I think the market will kind of be waiting to get some indication whether Jay Powell, A, is going to cut, and B, by how much. Market's still pricing in a real possibility he could cut 50 basis points next month, start off a cutting cycle real strong. However, if his language this Friday pushes back against that narrative, say we see a bit of a bump up in bond yield. One thing he's got to be happy with is the declining rate of inflation. Getting down to a 2-handle for the first time on CPI last week, along with many measures of inflation breadth coming down, some even running at an annualized rate of a 1-handle, below 2%. And I'll be interested to see if Jay Powell offers any opinion or commentary. Hopefully someone in the media asks him what he thinks is going to happen to inflation given whoever wins the election in November. Because a change in office could have a dramatic change on the amount of immigrants coming into the States. And if that were to fall off back to prior levels, that's a big deflationary force in the US economy as well. I think it'd surprise a lot of us if we saw CPI on a 1-handle at some point in the next 12 months. Counteracting that is the current government is spending at a record pace. Looking at government spending as a percentage of GDP, it's been running at 27% since 2020. And the fact is all governments have increasingly spent more. It's pretty much been in an uptrend over the last 70 years. And again, we got a mixed economic signal today, with the leading indicators index falling in July. However, it's not signaling a recession though. In fact, Goldman Sachs just decreased their probability that we'll get a recession in the next 12 months from 25% now back down to 20%. And they're moving this up and down pretty much every week with every new bit of economic data we get in there. So they think a 1 in 5 chance US economy will see a recession over the next year. I'd probably put it at 50-50. I mean, it's either yes or no. The bond yield curve, which is normally a pretty accurate indicator, is suggesting it. Fed fund futures, which are not always right, they're really suggesting it. Stock market's definitely not. High yield bonds are not. We are seeing some softening signs with the consumer. So me personally, I'd put it at 50-50 in the next 12 months. I think 20% is quite optimistic. But I can understand how they got there. Just looking at a dashboard of the US consumer, going back to 1980, looking at 6 key categories: spending, employment, income, wealth, debt, and confidence. With red being bad and green being good, yellow being in the middle. Average reading for these 6 categories, 55th percentile, which is pretty good. We can see confidence is not the best, nor is income, nor is spending. However, employment, wealth, and debt, all pretty green. Household debt, margin loans in the stock market, they're all well off peak levels, crisis levels, stuff we saw back in 2000, 2007, 2008. It's kind of a similar look to the mid-late 90s, maybe 96 to 97, with the amount of green and the color. And the fact is, we just came off the back of a really great Q2 earnings season. S&P 500 earnings up 11% year over year, and expectation continuing to increase. The market really kind of almost programmed to this chart here, along with liquidity, buybacks, interest rates. Big algos are really looking at forward earnings expectation, and that's pretty much been a straight line up since the start of last year. And even if we do get a recession, there's no need to freak out and sell everything. Just looking back in history at the Russell 2000 small cap performance, starting the chart off with the months after the first Fed rate cut. On average, the Russell 2000 will be up over 10% a year later after the first Fed rate cut. If a recession followed, kind of hard to believe, but the Russell 2000 still up about 8-9% a year later. In fact, its best return with a recession was over 50%, and its worst drawdown in the following year was about 20%. Funny enough, if no recession came, the best result we ever got was about 22%, although the average is higher. If the Fed cuts rates, we don't get a recession. Small caps are up on average 15% a year later. The worst they've done in that time is down 3% a year later. And I don't know about you guys, but this data here to me says that favors the bulls and being long. However, looking at this good chart here of the business cycle in the yellow versus the stock market cycle in the blue, if we are approaching a peak economic cycle when consumer spending, business spending, GDP growth, all of that peaks out and all of it starts to roll over, typically the stock market will see that before it actually happens. Stock market's normally 3 to 6 months ahead of the economy. However, when it turns out to be wrong, that's when you get those sharp changes in the stock market. Most of the time it's right. However, we are approaching top of the cycle. One of the best sectors to be in is number 9 and 11, which is energy and precious metals, which also happen to be at really good valuation. So my stock picks portfolio has a significant weighting to energy and precious metals and will continue to do so for likely several more years or longer. However, at the same time, we could still be in the middle of a bull market in which technology and other cyclical stocks perform the best. Then once we do roll over, you want to get into the defensive stuff. Healthcare, consumer staples, and utilities. Then back down the bottom, the best time to load back up into cyclicals and financials, typically the best, coming out of the bottom. But typically what you see at a stock market peak is a lot of companies rushing from private to public, coming to market with initial public offerings, IPO, and they are still well off those early 2021 highs. And so there's still a lot of signs out there that suggest we're not in that late stage speculative bubble mania that you typically see associated with market peaks, although we could be heading there. But this is why I do technical analysis. As I always say, technicals lead, fundamentals follow, and it doesn't matter if a stock wants to go to PE of 1,000, I want to let it do that and ride the trend. Just like the famous trader from the early 1900s, Jesse Livermore, famously once said, as long as a stock is acting right and the market is right, do not be in a hurry to take profits. And so he's kind of the pioneer of the adage, cut your losses, run your winners. And 120 years later, it is still very much true. Just moving on to the commodity markets, and then another good sign for inflation. Oil continuing to trade heavy, moving sideways for months now. Worries about the demand outlook. Things kind of cooling down for the moment in the Middle East. Could still blow up at any minute. However, for now, market not really pricing in any tail risk coming from that region. And we can see that looking at the chart of crude oil futures. Swiftly trading back down to the support zone, 73.60 a barrel. And I thought I'd share with you guys some interesting stats today on oil reserves by country. I think a lot of people will be surprised to know that Venezuela has 18.2% of the world's oil reserves. They have almost a fifth of the world's oil. After that, the Saudis with 16%. They do a really great job at extracting it and distributing it. Really high-end advanced systems, very efficient and well done. Canada does well. However, with 10% of the world's share, I think they could do better and even rival the Saudis. Iran does a pretty good job of it, as does the United Arab Emirates. Russia does a brilliant job at digging up their oil and distributing it. Really cheaply done, and they'll always have a big customer with China, with whom they share a border to the south. Nigeria, pretty good at exporting as well, and the state, now the number one producer in the world by far as well. Exceptional job, considering they only have 2.1% of the world's reserves, and pretty much at a huge labor cost disadvantage versus these other countries as well. So what happened to Venezuela? 300 billion barrels of oil. Well, again, I think a lot of people will be surprised. They're one of the world's most strongest economy. From the 1930s all the way up to the 1980s, 1990, just looking at GDP per capita, they were actually the richest country by far in South America in 1980. However, something happened in the late 1990s. They went from a capitalist government with Christian values to a socialist and communist government in the late 90s, which still exists there today. And so even though they have almost a fifth of the world's oil, they're now the poorest country in South America. When looking at GDP per person, significantly lower than all of their neighbors. With all their citizens suffering as a result, many people can barely afford to get by basic food and necessities, whilst those in power enjoy an opulent lifestyle. And it's not all those people's fault. They've tried to vote them out, and we've just seen that recently. But corrupt governments are hard to push out of power when they make their own rules. And like Milton Friedman once said, who I consider the best economist of all time, keep your eye on one thing and one thing only: how much the government is spending, because that's the true tax. If more regular people outside of finance understood this, they may vote differently, because people just hear this in the headlines. government spending, debt at all-time records. They don't really connect that to their own lives. However, if they realize they go to work 1 or 2 days a week just to account for their government's excess spending, maybe they would view it differently. And not every country has the privilege of having a global reserve currency and the ability to just artificially create new money in order to try and solve problems. It's really a band-aid fix on a long-term problem. Because like Javier Milei, who was just handed an economy similar to Venezuela, who'd been overrun with socialist and communist governments for decades and was already getting great results by slashing government spending, cutting out departments, privatizing companies, letting entrepreneurs drive the economy. He's already bringing inflation down, economic growth back. One of his best quotes: "If printing money would end poverty, printing diplomas would end stupidity." And I think we need more people like this in the world, telling it how it is, based on the data and facts. Or like Elon Musk suggested last week, how about a government spending efficiency commission, an oversight committee that keeps the government accountable, putting government spending on the blockchain? All these things sound like logical common sense. However, the fact is, not everybody's on board with that. Also frightening to see some measures being presented in US politics as well. Price controls on retailers, grocery stores. When you actually look at their financial statements, their margins are already razor thin. 2, 3, 4%. Don't be fooled. It's not price gouging by your local grocery store that's caused inflation. It is 100% excess government spending. It's not about driving energy usage towards zero either. Again, just looking at the data. There's no such thing as a low energy rich country. Down the bottom, GDP per capita. On the left, electricity consumption per capita. You can see poor countries don't use much electricity at all. The richest countries in the world use a lot. We just need to find better, more cleaner ways to get our energy instead of just digging stuff out of the ground and burning it. However, all this excess spending by the US government is not going unnoticed by those with large amounts of capital around the world. Just looking at a chart here, in the dark blue bars, net central bank gold purchases sharply increasing this last couple of years, and I don't think this trend is going to go away anytime soon. Can you imagine a real emergency and panic on the US dollar or US bonds in the years ahead of us? If the Japanese, Chinese really gave up on it, big institutional money swapped the traditional stock and bond portfolio for stocks and gold, the US dollar really became distrusted because they've just printed so much of it. And that, coupled with the fact that the most of the market still has really low exposure to gold, could cause a bull market in the precious shiny metal for years more to come. Just looking at a long-term logarithmic monthly chart of gold futures. After consolidating for over a decade from 2011, we've broken up to new all-time highs this year. And like I told my paid members on the weekend, you could think of being long gold is like being long US government spending that constantly devalues the dollar, for which gold is primarily priced in. And so instead of thinking of gold as $2,500 per ounce of gold, we could flip this chart upside down and you could think of the US dollar as being 1/2,500th of an ounce of gold. Being long gold is literally being short the US dollar. And just the way the US government is spending, it's kind of hard to see the US dollar not going into a long-term similar pattern to that of the Japanese yen, who have even a larger federal debt versus GDP. Moving on today to other news, and who I consider one of the most dodgy people in finance, and I've always thought so in my 20 plus years of investing. That's because we constantly hear stories like this from him. Securities and Exchange Commission announcing charges against Kyle Icahn and Icahn Enterprises for failing to disclose information relating to Icahn's pledges of IEP securities as collateral to secure personal margin loans worth billions of dollars. So he's already agreed to settle with them, basically pay $2 million, which is a slap on the wrist for him. And this came after last year when Hindenburg Research first highlighted the issue and accusing them of operating a Ponzi-like structure. And so I, for one, stay far away from investing anything Carl Icahn is associated with, including his company. And just at the back of Q2 earnings season, we still have a few more key retailers to hear from this week, including Target, Macy's, Urban Outfitters, Dollar Tree, and BJ's. And this is on top of the good retail sales report we got out last week, coming in better than expected. Just looking at the economic calendar for this week, not much out from the States. Inflation data from Canada tomorrow, few Fed speakers. Going into Wednesday, we'll get the FOMC minutes from their last meeting. Be no surprises there. Thursday, we'll get PMIs from the Eurozone and the States. And like I said, Friday morning, the big one, Fed Chair Jay Powell's speech. It's really come down to crunch time for him now. Is he going to cut rates next month or not? And if he is, how big's he going to go? To start the week off, Fed Fund Futures pricing in 77% chance he'll cut 25 basis points when they meet on the 18th next month. And we'll be looking to see how the market changes after it hears from Jay Powell. And I'm going to stick to my view where I put it about 70% chance they're going to cut 25 basis points. I'd put 20% chance they're going to stay on hold, and maybe about a 10% chance they cut 50 basis points. I still don't think that's likely. However, I could be wrong, and we'll just wait till Friday morning to get a better taste from that after we hear from Jay Powell. And just getting back to the charts now. Good price action today with the Russell 2000 reclaiming its 50-day VWAP. Really strong moves again for volume breadth. Amount of volume going into stocks advancing versus declining. Looking pretty good, and the percentage of stocks trading above their averages. Net new 52-week highs versus lows starting to pick back up. VIX still really low, 14.6. Option dealers not asking for much premium above realized volatility. In fact, they're asking 6 points lower. What gave us an early clue, along with volatility risk premium of this V-shaped recovery, is also high yield bonds, which only took 2 days to reclaim their 50-day VWAP after the initial panic 2 Mondays ago. Here we are trading up again today, and high yield spreads over treasuries continuing to contract, along with the price action in the Japanese yen continuing to stabilize. Bitcoin not really joining in on this everything rally, still trading below the 50-day, bit above $59,000 a coin. And this is a global equity rally as well. Canada's TSX sitting at highs. UK FTSE still consolidating above the 50-day. Germany's DAX ripping back up as well, not too far off all-time highs. And the Japanese Nikkei 225 just sitting below its 50-day. Coming in the softest of the bunch, China been pulling back a few months, just like a lot of commodities have as well. And the Aussie 200 quickly approaching highs again as well. Nice bounce back in high beta versus low volatility, sitting at the 50. Small caps still pretty soft versus large caps. Discretionary bouncing back versus staples. Still pretty soft there in copper. Credit spreads back to stable levels, and inflation expectations continuing to trick down. Pretty bullish breadth across all stock sectors today. Biotech leading the pack up over 3%. Here's a look at the biggest stocks. Apple just consolidating 225. Microsoft quickly approaching its 50-day. Meta doing one of the best. There's a look at Tesla and Nvidia. Among the best in this bounce back, up 4.3% today, quickly approaching all-time highs at 140. And we've had a pretty nice bounce back in all semis after those sharp sell-offs from 2 Mondays ago. Warren Buffett's Berkshire Hathaway breaking out to new all-time highs, closing in on a $1 trillion market cap for the first time ever. Currently $967 billion. That'll be a big milestone for Mr. Buffett to hit. And JP Morgan also close to hitting new all-time highs. And that wraps it up for this Monday, guys, to get you all prepped for this week. We're seeing if the market can test new all-time highs above 56.70. Typically, when markets do hit new all-time highs, they can pause, consolidate, retrace a little bit. So I wouldn't be surprised to see that happen. We have had a pretty stellar run here. 8 consecutive days higher, slapping on 500 points. However, the market may grind down to a low volatility going into Friday morning. Waiting to hear from Jay Powell and what his plans are for interest rates. That'll be the big one this week. However, like I said, really bullish risk-on sentiment across the board going into that, along with gold also sitting at all-time highs. Definitely the best performing commodity here. Thanks very much for sticking with Click Capital, and I'll keep you updated all week. And I'll see you back here again this time tomorrow. Cheers.